well, what do we mean by active versus passive?
Yeah, what do we mean? People say, I'm in a passive strategy, but everybody has a different passive strategy, so how can that be passive?
If you mean you're not really doing much, then that makes a lot of sense. But what typically is meant by a passive strategy is that you have no opinion on different markets, that it all is going to average out over time, and the time and the cost of underwriting that is going to be, it's not going to bear any fruit.
So it's kind of a set it and forget it type of strategy.
It is a set it and forget it type of strategy. And if you're getting market exposure, at the end of the day, it's going to work.
So you'll at least get the market minus whatever the fees are.
Right.
But even then, you could maybe not get the best performance even in a passive strategy, because
yes,
it depends on what you're actually buying in an asset class.
So what are you buying? If you're buying the S&P 500, about 25% of your holdings are going to be in just a handful of stocks. It's going to be dominated by Apple, Microsoft, Google, and some of the other big names. That may or may not be the concentration that you want. Remember, you're a passive approach. You're not doing anything. Also, is it truly a passive no opinion? Because a lot of people say, well, just buy the S&P 500. Well, if you're a truly passive strategy, you should have a market weighted, meaning that what is percentage of Apple versus all the other possible investments out there. So you would have a very small position in Apple, and you would have small positions in all the emerging markets, in the international markets. You would have small positions in all the available commodities and precious metals. You would have small percentages in private equity and venture capital and bonds. No one truly is actually a passive investor.
Right. Even if you're just in the S&P 500 and 25% of those are in these few technology stocks, as we talked about before, if we have a rising rate environment, that could actually cause those stocks to way underperform the others in the S&P.
Right. So since no one's really taken a passive approach, because if you're buying the S&P 500, you're saying, well, I believe these U.S. large capitalized companies are my best investment option, and why would I buy anything else? That means you have an opinion.
Yes.
And you are taking an active tilt. So I don't think anyone actually can achieve passive. But that doesn't mean that taking a passive approach, meaning that you're not going to pay for the underwriting and the due diligence, is the wrong thing if the markets are reasonably efficient. But then you get to the paradox of passive investing, which is the assumption is that the market is efficient, that stocks are rationally priced and are trading at a fair price given all the additional all the information known about them. Well, how does that happen? Active investors, they're out there trying to move the stock prices to a rational thing. So if everyone was to passively invest, then there would be a bonanza for active investors to do due diligence. So we think these things do go in cycles where there's a lot of active managers because there's a lot of excess return through underwriting and trying to understand what the business valuation is. And then they move them to more efficient prices, meaning there's less excess return, which means that there's only so many active managers that can support, and then you start to underperform the benchmark, and then you have a lot of capital that flows to passive strategies. And then all of a sudden there's a lot of movement in stock prices that are no longer rational or efficient. And then so we do believe this will just happen in cycles for active versus passive.
Well, and we also build it into our portfolios because we're going to have active managers in some parts of our portfolio at different times, or we may have passive strategies because we believe they're in that period where there is a better opportunity to at least maintain the market, because you don't have as much potential, perhaps, in those upsides.
Because of how we view the active versus passive debate, we're really agnostic. We will use ETFs if it has a specific basket of stocks that we want at a very low cost on the internal management fee versus a mutual fund. So we're just looking at it as what basket of stocks, whether it's in an ETF wrapper or it's in an active manager, which ones are working well, and that's what we're trying to move to. So that's our approach. And then the question is well, how effective could this be? And I think by looking at that March 2017 data, we can start to understand why we believe our strategy, despite what looks to be a very efficient market, is still a good approach to management. Knowing that everyone is doing truly active management. We all have some type of opinion because none of us are actually buying the true passive portfolio.